MAET, via the Munro Global Growth Fund, returned 4.1% for the June quarter. The fund's long positions contributed 5% to quarterly returns, while shorts and hedging detracted 1.1%. Currencies added a further 20 basis points to give us 4.1% for the quarter. Global equity markets had another strong quarter, continuing the strong rally that we've seen from the COVID lows. Market performance was driven by rapidly rising earnings estimates as market participants continue to underestimate the strength of this economic recovery and companies' abilities to profit from it. From the fund point of view, the quarter was volatile, but ultimately positive. The strongest contributions came from our high-performance compute leader, NVIDIA, also from e-commerce winner HelloFresh, and from software megacap Microsoft. Detractors during the quarter were mainly a result of our higher multiple positions that underperformed in the higher interest rate environment, and these included The Trade Desk, Uber, and Twilio. We also had some losses on hedging positions as we tried to hedge out some of the volatility during the quarter. Looking ahead, the second quarter results season is now upon us, and this should actually be the high point for reopening earnings growth that we see in the market. We think it's noteworthy to mention that long-term interest rates and inflation expectations have not actually breached their pre-COVID highs and have now actually begun to retrace. As we look forward, we think investors are actually going to start to look beyond the reopening and they shift their gaze as to who can actually produce earnings growth over the longer term. And this should ultimately benefit our strategy. Our digital areas of interest where growth accelerated during COVID-19 look likely to retain these gains. Be it hybrid workforces or groceries delivered online, we do think these changes are here to stay, and this should drive strong medium-term earnings growth for a number of our digital holdings well into the future. Outside of the digital areas of interest, we also see strong earnings growth for a number of our emerging consumers names as economies slowly reopen. And then finally, the global infrastructure policies we see coming into place are also likely to help our climate area of interest. To conclude, we remain generally positive on equity markets. While clearly some tail risks remain, the backdrop of economic growth on the whole broadening and global interest rates on the whole likely to remain structurally lower creates a good environment for companies with the ability to grow over the medium term, where equities will clearly be the asset class of choice if this environment prevails into the future.